Welcome, Leith Van Onselen and Cameron Murray, Dr. Cameron Murray. I should say thanks so much for joining me. Reached out to you both yesterday, and it was great that we could coordinate a time where we could do another three-way interview to talk about what's going on. What's going on with each of us and what we're seeing. Leith, obviously you write Macrobusiness, which is a daily blog covering all recent news and also, blowing apart any myths surrounding supply policy, interest rates, what the government's doing with immigration, how that's impacting rental prices and everything. And it's one of the most useful resources out there for anyone that wants to have an understanding of the realities of what's going on in the economy, not just what the mainstream is talking about. And Dr. Cameron Murray, very similar, coming from you, from your fresh economic thinking, which Substack, which everybody should check out. And I'll put a link so that everybody can see where they can get hold of your writing. And obviously you've authored a couple of books as well, which really, again, like takes a very contrarian view against mainstream narrative to look at how housing policies really do impact the markets in Australia. So even though we're on this long cycle, and even though I talk all the time about an 18-year cycle that has been well researched and has a lot of history behind it and has enabled people over the last century at least to make some amazing forecasts, very accurate forecasts of where the downturns are going to occur in the economy, how that impacts local markets is a completely different thing. And for that, we do need to look at the fundamentals of what's going on, and we do need to clear away what they're saying in the mainstream media and really get to the nitty-gritty of it. So I thought maybe we could open up, and I'll swing to you, Leith, to give an update of kind of like, you've just come back from your Christmas break. So maybe we can have an update of how enthusiastic you are to return and what you're seeing occurring in Australia right now, interest rates, what's going on?
Yeah, so look. The big news this week was we got the Q4 Consumer Price Index inflation data from the ABS, and it was pretty good result. I mean, good result if you're someone who's got a mortgage and obviously is hoping that interest rates fall. So the key figure out of that was the trimmed mean inflation. So what that is, that's the thing the RBA is looking at the moment. It's the inflation rate once you trim out the most volatile items, and it basically excludes the impact of energy subsidies and these sorts of things, which have suppressed the headline inflation rate. And the all important figure from that was that the trim mean inflation only went up by 0.5% in the fourth quarter, and the 6-month annualized rate, so that's if you take the last 2 quarters and annualize them, was at 2.65%. And both of those are within the Reserve Bank of Australia's 2 to 3% inflation target. And they're also, Australia's trim mean inflation now is below what Canada and the US is, for example, which are now who are cutting interest rates. So, most economists seem to think that the RBA is very likely to cut interest rates at its next meeting on 18th of February because of this data. There is a possibility the RBA could hold off maybe to the 1st of April, the next one, based off Australia's low unemployment rate of 4%. Because stupidly, I don't know why they do this. I don't know why the RBA doesn't talk to the ABS and they don't coordinate better, because the next monetary policy meeting of the RBA is on the 18th of February, but on the 19th, we get the fourth quarter wage price index. So that's the wage price data. And then the following day, we get the January labour force survey. So I would have thought that's, information the RBA would probably be pretty interested in before they make the next decision. So there is a possibility the RBA could wait for that to move. But I think, it's very likely it's, if I had to put money on it, the RBA is likely to cut at its next meeting in a few weeks. And there's going to be pressure on the RBA to cut as well, because we've got an election coming up in probably May. They could call it beforehand, but it's got to be at least by mid-May. The Albanese government's trailing in the polls. It's under heaps of pressure because of the cost of living crisis, etc., and basically been in a pretty ineffectual government. And they're going to be putting the pressure on the RBA to cut interest rates before the election. And based on this inflation data, there isn't really a reason for the RBA not to cut. And as a result, I think they're going to cut rates, but we'll have to wait and see.
Well, you say there's not a reason for them not to cut, but everybody's eyes in Australia really are on the housing market. Obviously, Melbourne's housing market has come back, and that's primarily because of the land tax policies. They wrapped up land tax, they put taxes on Airbnb rents, they've got the vacancy tax, which they've expanded to cover the whole of Victoria. And all I've done over the last 12 months is hear story after story about investor that is selling. That's increased supply in Melbourne, and it's not pleased Melbourne's real estate agents or property owners, because the market's pretty much stagnated. It's done nothing. It's going backwards unless you've got really good property. Your property price isn't going to fly. However, the other housing markets aren't doing as badly as that. Perth's market is still roaring ahead. Adelaide's market is going very well. Brisbane's market is going very strongly. Sydney, okay, you know, Sydney's come back as well, but that's not surprising, you know, for, you know, considering the prices in Sydney. But if they cut rates, it's just going to fire up the property market again. And we, you know, that's primarily, you know, the area of impact where everybody's looking for rates. I mean, don't you think that that would deter them in any way?
Not really. No. I mean, look, I mean, Sydney's housing market's falling. Brisbane's coming off pretty hard. They're all slowing now. If you look at the CoreLogic daily dwelling values index, you know, yes, yeah, Brisbane's still growing. Brisbane's still growing slightly. Adelaide's growing, but they're all coming off. And Sydney and Melbourne are now declining. Not sure about the smaller markets like Canberra and all that, but who cares? But look, you know, the RBA is not looking at that. I mean, if they are, they're looking at it as very background issue. The reality is we are in a 7 consecutive quarter of real per capita GDP decline. Australian households have just suffered their biggest ever decline in real per capita household disposable income. So they've fallen by over 8% in the last, since the Albanese government came to office in mid-2022. Real wages are down more than 7% from peak. And they're not actually, you know, forecast to rebound materially if you look at the RBA's forecast, etc. So, look, you know, we are suffering you know, we have a very weak economy, at least once you strip out population growth. Pretty much all the growth Australia's had has been in the non-market sector. So that's government related. So, you know, thanks to the boom in the NDIS and public works and infrastructure and stuff like that, that's pretty much driving all of Australia's growth at the moment. It's also driving almost all of the jobs growth. The private sector economy is in a very deep recession. And those are the sorts of things the RBA is more likely to look at. And the fact that the inflation rate is now, you know, seemingly under control, it suggests that the monetary policy is too tight and the RBA will ease at its next meeting. Yeah, sure. Cutting interest rates will, you know, provide support to the housing market. It should increase house prices a bit, etc. But that's secondary to the RBA's thinking, I would have thought.
It's never been.
Can I just jump in on that?
Rates, but you
Catherine?
can. I was coming straight to you for it. Because, yeah, it's not been my forecast, but you're in Brisbane and you would know intimately what's going on, because as I connected with you before I hit record, you were pretty keen to see what was going on with the house auction 3 doors down. Is that right?
Yeah, well, I'm actually currently, that's the 8th on a series of 11 auctions of my local real estate agent. I'm watching them now. Plenty of bids on the first few houses. It's an online facilitated one. But just to Leith's point about the RBA's consideration over the effect of reducing rates now on sort of re-stimulating home prices, I think there's a bit of a safety buffer already built in, because if you look at an index of how much can a typical household afford to pay at current interest rates for a home, it's far below what the current pricing is. So actually the current pricing already reflects a much lower interest rate. And I think we're in a bit of a holding pattern here. So even if rates come off 0.75 of a percentage point, 1% over this year, prices will be then much closer to matching you know, what people can afford. And I don't think that in itself will then trigger another sort of explosion of prices. It's just going to sort of stop stop a major price correction before it begins, potentially. So I think there's this buffer around of sort of 1 to 1.5%. So what's the cash rate today? 4.25?
4.35.
4.35. So if the cash rate was sort of 3%, I think you'd sort of, if it came down to 3% over this year, I think you'd see prices fairly stable. They might bounce a little in Sydney, where they've been flat for a while. They might bounce a little in Melbourne, where people have been cautious, but I don't think it's going to cause a national price explosion simply because prices already reflect that lower interest rate now, right? So
And
when the forecast is fulfilled, then we all guessed correctly, and there's no need to adjust prices again.
yeah, and to Can's point, just to add to that, 3% is around about where the various banks, I think CBA, etc., reckon that's sort of the neutral interest rate. So, and they seem to be tipping that the cash rate would get maybe 4 cuts or something like that, maybe 4 or 5, get down to around about that level. So that sounds about right, and it happened over a period of a year, probably 1 per quarter, exact. Not a mad rush to cut interest rates, probably just pretty steady over the year.
Yeah, and I think you'd expect a bit of a refinancing surge again as people try and take advantage of that. But it's gonna, it'll be incremental and slow because people will think, oh, okay, they cut 0.25 percentage point this month. Oh, I'm not going to refinance yet, right? Because there's not much gain there. And then later in the year, more people will start coming on and going, yeah, let's see if we can get a better deal. And then I guess mortgage interest rates now are around what, 6 to 6.5%. For most people. So you get back down to around 5%. And I think that makes a lot of sense given yields are around 3 to 4%. Usually the interest rate's about, maybe 50% more than the yield on average. So I think you also got to consider the global situation. So Canada, everyone else is cutting interest rates. We can't just be the lone wolf here. So I think that's already priced in the currency as well. So in a way, we sort of have to go with the herd. And I think it's sort of sensible timing. I'm glad they didn't cut a year ago. I'm glad we've had this sort of long pause, because if you look at, for example, construction prices, we really wanted to slow down construction orders and get those backlogs under control. I think from what I've heard, that's pretty much under control now, and people are starting to bring forward some of those apartments and bigger projects. Is that how you see it, Leith?
Yeah, pretty much.
Yeah.
Certainly. I think a year ago would have been a mistake. Obviously, we had much higher inflation a year ago as well. But I think now the timing's pretty right. We're sort of getting towards that sweet spot, and as long as they don't do anything drastic and cut by 1% or something like that, which they won't do, and it's just steady, I think they'll just get back to that sort of what the economists seem to think is around about that neutral range, which is sensible. I mean, the rest of the world's cutting now, and Australia's pretty much out on its own now. So and we shouldn't forget though the political implications. Like, sure, the RBA is not going to be looking at the election necessarily, going, oh look, there's an election coming up, gee, we better deliver a rate cut to help the government, but there will be pressure on them not to ignore the data. So that'll be coming thick and fast from the government. And it's, it is pretty hard to keep the interest rates where they are at this restrictive level when you have, when the smoking gun of inflation has, moved pretty much back in line. It's actually running well below what the RBA projected in its November statement of monetary policy. So headline inflation was only 0.2%, but that's been duped by the energy the energy subsidies, but the trim mean inflation, both of them, headline and trim mean, is running well below what the RBA had forecast just in November. So it's come down a lot faster than they were expecting. So, based on that, it's pretty hard to justify keeping interest rates where they are.
It's an interesting perspective, because I did interview Lou Christopher, who I think we'd all acknowledge is probably one of the best short-term housing forecasters in Australia. I mean, his forecasts have been extremely accurate over the years that I've been following him, probably since around 2015. And he was certainly of the opinion that if they did cut rates, it would be quite a big boost to the property market. I mean, I acknowledge that, you know, I mean, forecasting this cycle as I do, one of the patterns that is pretty evident in it when you look back historically is that when you get to the second half of the cycle, rates do inch up and prices do follow that, you know, because they inch up in respect to the economy improving, and eventually they get to a point where they do break the market, you know, and it gets to where the productive sectors of the economy can no longer afford the debt, and you get this crisis towards the end. I mean, that's the economic understanding of the cycle. I know that.
Well, I think it's, Catherine, just to interrupt. I mean, I think that's right. I think the point of making some cuts now is to avoid a more sudden correction in, say, 18 months time, end of next year or after, if you kept rates high. You know, if you can reduce the pressure a little now, you can hopefully soften any downturn. I think that's the logic, both here and globally.
There's no doubt that the COVID pandemic that triggered the mid-cycle, which this is the thing about cycles, and this is why we have to take them into account whenever we do any analysis on this, because it was very easy to forecast that there would be a downturn at that point in the economy. It just wasn't easy to understand what would be the trigger for it and how it would impact the economy. And how it impacts it obviously causes the waves ahead. But the next downturn is also priced in, and the next downturn will be down into 2028, and we'll talk about that in a minute. So, I mean, you could be right in terms of keeping the market going until that point, but there is an inflection point when you deal with cycles, this ability to forecast decades ahead, where the year or around the year where a significant recession is going to hit the economy, and at the point at which property prices, land prices are going to be impacted, has to form part of that analysis as to how things are going to play out. And I think with the, you know, the COVID pandemic that triggered that, and then the property boom that we had, which was akin to the 1989 inflation in land prices, how quick that occurred between 2020 and the beginning of 2022, and then the sharp rise in rates obviously did shock the market. I mean, I'm not forecasting any downturn for 2025. I think 2025 is going to be a strong year. Every bit of analysis I'm doing that is proving that. But certainly I agree that a rate cut would assist the markets. I mean, do you see that there's been a bit of a slowdown in Brisbane's market? I mean, my feet aren't on the ground there, so I'm only looking at the stats. What are you seeing with the prices that you've seen a property sell around you? Has there been a slowdown?
Yeah, definitely they're not rising anymore. But I haven't noticed any areas where there's been major corrections yet. There seems to be plenty of patient sellers. I have noticed quite a few, you know, homes advertised that didn't sell, and then, you know, they take them off the market, and they're trying to sell again now. People who tried to sell a year ago and just were patient. So yeah, in Brisbane, I haven't noticed any desperation yet that would lead to substantial corrections, but you know, the market can correct in real terms quite substantially, even if not nominal terms, right? So if we have 2.7% inflation for 4 years, that's 10%. And if we have flat nominal house prices and a slight decline in interest rates, then that's a really big adjustment, you know, 25% change in how affordable that nominal price is. So I think we're going to see a bit of a period of that. It's hard to see how that plays into the longer term cycle though, right? Because you don't usually get more affordable at the end of the cycle. So that's going to be very interesting in the next couple of years. What are your thoughts, Leith?
Yeah, look, I mean, the only thing I've got to go on is the, you know, CoreLogic's daily dwelling values index, which obviously track, and that shows that Brisbane's slowing. So it's still growing. It's just that in the last, say, 28 days, when I looked at it a couple of days ago, it grew by 0.3%. Whereas, you know, 6 months ago, it was growing at nearly 1%. So it's starting to, that price momentum in Brisbane is starting to slow. And you know, if you extrapolate that down, it's about 6 months behind where Sydney was, and now Sydney prices are falling. But you know, Sydney and Melbourne aren't falling drastically; they're just having that sort of slight grind lower. But and of course, that means in some suburbs, you're going to have some suburbs you're going to correct. Probably the more expensive ones will have, you know, could be falling by 10%, but then you got the more affordable ones are probably still rising. You know, so there's always a lot of intricacies in the market. I will say though, I think Brisbane's probably due. Like the price growth there has been absolutely phenomenal since COVID. And watching from a Melbourne, you know, from Melbourne, when you now look at Brisbane's median house price, dwelling price is now above Melbourne's. That's something I never would have imagined 5 years ago. And I just look at it and go, man, this, you know, the prices up there do seem to be getting a little bit absurd and, you know, above fundamentals. So we'll have to see how it goes. Probably wouldn't be a bad thing if prices came off. And it's interesting watching from a Melbourneite's perspective. There's a lot of bleating down here about this impact of these investor taxes and all this sort of stuff, and there's lots of whinging about it. But if I take my homeowner's hat off and I look at it from a prospective first home buyer, it's actually been a bloody good thing. So Victoria's got a higher share of first home buyers than any other major jurisdiction. We've also got a lower, you know, share of investors entering the market. So, you know, logically, if you have less investors, you get first home buyers. They're negatively correlated with each other. And the fact that the Victorian government smashed the investor side has basically benefited first home buyers. And you know, there's also a lot of whinging often in the media saying, oh, this is just going to push up rents. Well, actually, rents in Victoria are actually rising at a slower pace than the rest of Australia as well. So it's been a tick in every box if you're a prospective first home buyer. You're paying, your rents aren't rising as quickly as elsewhere, so you can save up a deposit quicker, and you're not getting smashed on that side. And then it's cheaper to buy a home because it's become relatively more affordable down here because there's less investors to compete against. Which, from a policy perspective, if the policy objective is to boost the rate of home ownership, that necessarily means you need less investors in the market. Like that's just the reality of it. You need to, if you lower the investor share, investors entering the established market, it means you get more first home buyers. And if your goal is to boost home ownership, you need less investors. And Victoria's done that, which has actually been a policy win in my view.
Oh, I totally agree with you. Obviously, being present at Prosper Australia, we've been talking about this quite a lot behind the scenes. It was a brave move to make as a treasurer to implement those policies, and they're policies that we had been lobbying for a long, long time. You know, gosh, all over the time of writing the speculative vacancies reports. And I can remember going and, you know, sitting in Senate inquiries over the years to talk about, you know, what needs to be done to make property affordable and you know, to make prices come backwards, because that's how you make property affordable. And that's precisely what they've done in Melbourne. And in my own business, most of my business is run, I would say, in the lead up to COVID, it was mostly investors. And obviously since the rate rise and since these policies in Melbourne, I've just got such a high number of home buyers that I'm dealing with that want to get into the market. So it's very, very interesting to see how that has impacted the market. And that's obviously what land tax is designed to do. It's designed to lower land prices, to stop that speculation, to clear the investors out, and to make room for home buyers. And, you know, it's had the effect. But what I want to swing onto now is, obviously, if we get a rate cut, that makes it more feasible for developers to enter the market. And the piece that I'm writing at the moment, and hopefully I'll be able to finish it in time. I always have this panic as I get to the end of the week and thinking, oh, I've got to get this land cycle investor report out. But what caught my interest is that the Jeddah Tower, which has been forecast to be the world's tallest building for many years now, has recommenced construction at quite a rapid pace. And the date for completion is 2028. To give a little bit of history, the Jeddah Tower, right back into the, you know, when I first started writing about it in 2014, I don't know when it was initially announced, but in 2014, it was due to complete in 2020. And it was one of the primary reasons that I said 2020 is going to be a period of economic distress. a recession. It's going to be the mid-cycle point of the 18-year cycle. And that's because the research that's been done on what is now termed as the skyscraper curse, it's had all sorts of different names put to it, has unequivocally shown that the completion of the world's tallest occurs in a recession. And it's one of the most uncanny indexes. But whereas we can look at things like yield curve inversions and what GDP is doing and make these forecasts, which are relatively short term, the announcement of the world's tallest has a period of years. So if you're making a big capital investment, to have that date come forward and to be able to make an accurate forecast based on that, which I did back in 2014 when I said, oh, you know, there's going to be a downturn in 2020, is pretty incredible. So now it's come out and it said, okay, you know, the forecast date for completion of the Jeddah Tower, they're even saying that it could be higher than initially forecast. It was going to be a 1 kilometer tower. They're now saying it could be even higher. I mean, these are phenomenal works of engineering. And, you know, I mean, just kind of phenomenal to see that. But to read that and to read this forecast date is sort of solidifying that, okay, you know, it's not unusual. I've been forecasting a downturn into 2028 for a long time, but it kind of like solidifies that date into it. So anyway, let's swing it back to Australia. You can make a comment about that if you want. I don't know if you've been following the story, but, you know, how's it going to affect? We've obviously had a record amount of developers going into administration over the last few years. Since 2018, it's been extremely difficult for the development sector because they had the Royal Commission into the banking sector, which restricted finance. Then we had COVID and the inflationary rise in building materials. You know, now it's decimated the market and we've got high rates. Do you see any recovery into the peak of this cycle?
Yeah. So I mean, home building is recovering slightly. It's still very soft though, and it's nowhere near Albo's fantastical 240,000 homes a year target, which is just very unlikely that's going to be cheap. You know, 240,000 for 5 years straight, when the highest construction we've ever had was 23,700, I think in 2017. So it's, you know, about 9% above what our highest level ever was, and they want to do it for 5 consecutive years. It's not going to happen. But yeah, certainly, I think we're past the low point, and all the dwelling approvals, commencements data suggests that we're past the low point and it is rebounding. It's just not rebounding very much. And the reason why it's not rebounding very much is pretty simple. They've obviously got the higher interest rates we've just mentioned, but those should come down a bit. And just to put that into perspective, when we had that record housing construction in 2017, the cash rate was 1.5%. It's now 4.35%. So that obviously makes it more expensive if you're a prospective buyer. It also makes it harder to get finance if you're a developer. But the bigger problem here is the rising construction costs. So construction costs have gone up about 40% since the start of the pandemic. And although construction inflation's eased, that's a structural shift upwards in costs. So they've risen by 40%. They're not going to come back down by 40%. It just means that they might, you know, instead of next year being 42% up, they might be 41.5% up. So their inflation's come out, but we've got this embedded higher cost structure now across the home building market. And that obviously makes it way more expensive to build homes. It also means homes are going to be smaller, and basically it's more expensive at every price point, and the supply curve shifted, you know, effectively left. So on top of that, we've also got obviously labor shortages. So there's a shortage of builders to build this stuff. Builders are now competing with state governments for their big build infrastructure projects. So, you know, we're at the same time as the government wants to build record numbers of homes, the state governments, state governments are now building record amounts of infrastructure. So that's taking resources away. And we've also seen thousands of home builders go bust over the past several years because of these factors. So effectively, supply is going to remain constricted compared to what it was before the pandemic, and which means that we're going to struggle to build enough homes. And the thing that really irks me about this whole situation is that you think if you had a, you know, reduction in supply, structural reduction in supply, that the government should therefore reduce demand to compensate. And I mean, reduce population growth through immigration. But instead, the Centre for Population's latest projections for Australia's population growth over the next decade, which came out last month in December, projected that Australia's population is going to grow by 4.1 million over the next decade. So that's 410,000 a year. It's basically a Canberra every year for the next 10 years. Melbourne's going to grow by 1 million. Sydney's going to grow by 900,000, and Brisbane and Perth are both going to grow by 500,000 each. And this is all going to be from, primarily or almost all from net overseas migration. So the federal government, according to these projections, is going to keep firehosing demand through high immigration and high population growth at the same time as the supply side is going to remain constrained for the factors I just mentioned, which is an absolute disaster if you're a policymaker who proclaims that you want to solve the housing shortage, because it's just not possible. If we're going to keep running this high immigration program and we're going to keep firehosing in, 410,000 extra residents into Australia every year, mostly via immigration, well, then you need to build a hell of a lot of homes. You need to build a hell of a lot of infrastructure. And how the hell are we going to do that when you have 40% increase in construction costs since the pandemic? You got higher interest rates than we had before the pandemic, and they'll remain higher than they were before the pandemic, most likely. And we've got a whole bunch of, and the construction industry is basically on its knees, and builders, every week we read about builders falling over and going bankrupt. And we've got, builders competing against state governments for labor. So, this is just a diabolical situation for renters in particular going forward. And I think these, structural housing shortage is just going to get worse and worse, in the next, for at least till the end of the decade. What do you reckon, Ken?
I don't really think there is a structural housing shortage. We outbuilt all through the 2010s an enormous amount. The number of people per dwelling is at record lows, and all the boomers are going to die or downsize in the next decade. So that in terms of the distribution of large homes that people really like, those will be freed up. It doesn't necessarily mean they'll be bought by large families. We allocate homes on price, not need. So if a young, wealthy, no children's couple wants the big mansion in the fancy suburb, they will get it. So yeah, I don't see that. I think it's worth keeping in mind also that during COVID, everyone decided they needed a home office and an extra bedroom. And the effect of very small changes to the total occupancy of the housing stock has very large effects at the margin, right? So even if 10% of people want 20% more space, you're talking like a 2% increase in the stock of homes, which is like a year and a half's worth of construction. And so, there's demand for housing space from those effects as well as from additional people. I thought it was a bit of a mistake after you've had all this increase in domestic demand for space to then open the borders when, we're sort of as tight as we want to be within the housing stock. I think that was a big mistake. But I think the other adjustments have happened since. We've had a lot of construction. A lot of the immigrants are, sharing a lot of people to a home or in student housing. So they're sort of being absorbed in particular ways, even though the effect is really acute in some suburbs. But I don't think there's an overall sort of structural shortage. And I do expect quite a substantial resurgence in construction in the next few years. A lot of builders have gone broke, but builders sort of go broke all the time, right? It's not like one of those long-lived companies. People sort of start their construction company, try not to put too many assets in that company structure and go broke if a project blows out. So we're also seeing a renewal in new construction companies as well. These same people are going to reform into other companies and take on jobs. I know a lot of developers in Brisbane have started their own construction arms now because of that, and they're poaching people out. I'm literally looking out the window at a project now that's being constructed by a new construction company started by a local developer who is dealing with these other builders who are, in risky situations. So I think we're actually going to see a surprise resurgence in construction, in the next couple of years. But yeah, I don't think there's a structural housing shortage.
What about the collapse in the rental vacancy rate? How do you explain that?
Yeah, see, okay, well, rental vacancy, this is a common sort of metric people use. And I think you've got to understand it not as a measure of relative quantities of stocks, but of relative flows of people adjusting. And so you can have a low rental vacancy with the same number of households and the same number of homes if you just get all those households get higher incomes, because those households with their higher incomes will try and reorganize and outbid the other households to upgrade and move to better locations. And that process will squeeze vacancies and increase rents, despite there being no sort of relative change in the stocks of houses and people. And so rental vacancy is just almost another name for rising rents. Like it is the same process that causes rising rents from any cause will also cause tighter vacancy, because if there's not tighter vacancy, how do you know to put the rent up, right? So it's this same process, the two blades of the scissor of rising rental prices. And so there's plenty of cities around the world that haven't had population surges, but have had the inflation surge since COVID, that have seen rising rents and low vacancy, right? And we've seen that. We've had the added factor of this sort of huge unexpected immigration surge. And that's why I think it's taken longer for our rental inflation to come down. So if you think of rental inflation as a pulse, the cities that didn't have large inflation had a tight pulse, and then we had a longer one, because we had, in addition, this effect that sort of kept that process going. But it's not all due to that. And we saw remember 2006, we had the huge surge in immigration, rising rents for a few years, all through the 2010s, right? Real rents were falling essentially. So I think 6 years in the CPI from 2014 to 2020, the rental index.
But the difference is we had a massive construction boom then of high-rise apartments. We're probably not going to get that this time.
Oh, okay. Well, we should make a bet. I think we will. I think just like we did a few years after the sort of financial crisis boom, we got this huge resurgence. What is it today? 2025. Probably we'll get similar sort of elevated construction in the rest of this decade. Yeah, and I think it will surprise a lot of people. So we'll have to come back and test that prediction.
Yeah, so you're tipping a similar construction boom, like what Albo's housing target, or not quite that high?
Maybe for a couple of years in there. It sort of depends, right? It depends, because we might have a bit of a correction. We might have this sustained period of sort of slower nominal growth, slightly lower interest rates, rising construction, and then we might have a little price correction that will pause it, and then we'll drop interest rates again, and then all of a sudden all these adjustments have taken place and housing becomes affordable, and we get the real sort of second wave surge of construction, which is sort of pretty common in most cycles. So that's how I see it unfolding. I don't think we're going to hit 240,000 a year for 5 years in a row, but you've seen we've bottomed out from housing commencements in the recent data. It's rising again. If I look around Brisbane, lots of projects now getting out of the ground. A lot of big projects finishing up. The casino finished up in Brisbane. Some of the hospital jobs are finishing up. So yeah, I think we're going to get a wave of higher density construction, in the next 5 years. That will sort of be a bit of catch up as well for this population, as people try and spread out.
I fully expect construction to rebound from where it is now. I just don't think it's going to be a very strong rebound. So we'll have to wait and see. But and it's certainly not strong enough to counteract 4.1 million additional people in the next 10 years, which is just bananas.
Well, here's a question. Do you think, the Germany has now passed a bill through one of their houses of parliament yesterday about limiting immigration. Canada seems to be tightening up. The US obviously elected Trump and is tightening up. Do you think Australia is actually going to go, hey, you know what? 600, 700,000 people a year is probably a bit much. Like, are
I
we
hope
going to
so.
see a political shift that we've seen globally? Or are we going to just miss out? Are we going to be late, or are we going to miss out on this political shift?
Mate, I hope we do, but I don't have much faith because we're seeing Peter Dutton, who's the obviously alternative prime minister, kowtowing to China and India. He's done heaps of pronouncements saying we're going to have closer ties than ever to China, and he fully supports the Indian migration pacts that Labor signed and etc. And he keeps talking it up. So I think Dutton's talking out of both sides, and he'll just be another safe hands for the population Ponzi. And we saw it on the weekend. Abel Rizvi and co. all came out with a massive thing warning against migration cuts, and it's already starting. And it's
Yeah.
interesting that the coalition's latest, election statement on immigration came out a week or so ago. It doesn't mention. He said he wants to cut the permanent migrant intake for 2 years to 140,000, but he doesn't mention temporaries or anything. So I don't think we're going to get much change. It'll be a bit lower under the coalition, but the fact of the matter is the Greens are absolute open borders nuts. They can never have enough immigration. Labor likes big migration, and Liberals like big migration, maybe just a tiny bit less than Labor. So I don't think Australia is going to change from the policy it's had in the last 20 years.
Do you think then that the One Nation is what's One Nation on it? Like, who's our minor party? Because I think that's in Europe how things became leveraged, right? Because they have
Yeah,
these multi-party systems, and the rise of a minor party can then undermine another coalition. And so I think in Germany, it was one of the majors voted with the Alternative for Deutschland to pass this, right? So the leverage came through this alternative party, and in Australia that would happen by sort of marginal Liberal seats going to One Nation or something like that. Um, what's One Nation's view? Do you think there are marginal seats in an alternative party that can create that leverage so that the major parties have to do something?
it's pretty hard in Australia's political system. I mean, we've basically got a two-party system to get that much influence. But yeah, I mean, mate, I'm always hopeful. I just don't think it's going to come. So I just don't trust our political process. I don't trust our media. I don't trust any of it to deliver
Yeah.
it. Australians are pretty. If you go by all the opinion polls that are done, Australians want lower migration, but
Yeah.
our political leaders never seem to give us what we want. So
I
we'll have
guess
to
in
wait and see.
Queensland, I see lots of uh, marginal seats potentially going to One Nation and the Katter Party and stuff like that at state level. So probably Victoria still seems pretty woke and probably.
Mate. It's the problem is you're like you'd be looking through this through Queenslander eyes because that's what you see locally. I'm in Melbourne, and that's how I think we've got different views. Melbourne is the antithesis of that. It's still everything's still net zero and all this other stuff and all this identity politics down here. So yeah, I mean, I hope you're right. I just don't have much faith, and all the signals coming out from Dutton are more pretending to care and pretending to do something.
So if the election's in May, who's going to be the one talking about migration during the campaign? No one, or just One Nation, or are they?
Oh, probably Dutton. I mean, Dutton will say things, but I just don't think he's going to change much when he's in.
Ah,
So
okay,
so
okay.
so his policy is effectively what Morrison ran. No, what happened under the Morrison government. So Morrison ran a permanent migration program of 160,000, but they just kept the pedal to the metal and temporaries, etc. And Peter Dutton's basically doing a similar thing. He's going to cut permanents by a little bit more, but also the humanitarian intake's higher than it was back then. So it's gone up by about 10,000. So, it's effectively, I think he's just going to revert back to what the Morrison government did when we still had very high immigration. So, and unfortunately, the Australian Treasury, as we know, have got their thing. We'll have their we'll be talking into Dutton's ear, trying to dissuade them from cuts, etc., and using their Orwellian Centre for Population as providing all the evidence, the fake evidence they need against it. So I don't think things are going to change, unfortunately. But I hope they do.
Okay.
I can intervene in this discussion a little bit, because what I think is interesting about the, and that was a really interesting debate, by the way, to listen to both perspectives. I agree. I'm kind of looking at this from a Melbourne perspective, but what I'm also seeing in Melbourne, which I think has to be taken into account, is everything that we see is just what we see in the statistics in terms of, in terms of supply, how many properties are on the market for sale compared to how many people that actually want to buy today. And in the rental market, what the rental vacancy rates are saying, which are, I think SQM put it together based on properties that have been advertised for 3 weeks as a percentage of investor-owned stock. So it probably gives us the best indication of what those vacancy rates are. But of course, the underlying thing that we don't see are the reports that we do at Prosper, which have always been extremely interesting, and that's the speculative vacancy reports, which really do look at how many properties are perhaps lingering under the radar that have been vacant for a period of 12 months based on water data usage. And the latest report that we did, and we've been getting more accurate as these reports have gone on, the analysis that goes into it is far more granular as to, how do we assess what is a vacant property, what might be just an underutilized property, how do we get it more accurate compared to the amount of housing stock that is out there. There's something like 100,000 properties around in the last report. What's interesting about that, of course, is that those properties won't evidence themselves until a point comes where somebody has to generate income from that property, which is generally a downturn. And what you'll see when you look historically at downturns, property downturns, is that the supply of rental stock goes up because people are trying to generate income from assets that they can't sell at that time because prices have come back. So you'll see a lot of apartment stock go on the market for rent. You'll see rents, fall backwards because there's so much stock on the market. The other thing that's interesting, and this again is a very Melbourne-based thing, but it's what I hear on the ground, is the rental legislation has become a little bit bananas in Melbourne. Nothing wrong with having rental legislation to have safe property, but I have investors that don't have a high amount of debt on their investment properties that are being told that they need to lower their range hood by 5 centimeters, otherwise it's not compliant to rental legislation. And for one that was a house that was only 4 years old, suddenly the plug point is too close to the sink, and so people are saying, well, forget it, I'm not even going to rent it out, I'm not even going to bother having a tenant in it. So all of these like minor dynamics sort of play into this as to what we're not quite seeing on the surface when we analyze the data that's available to us. And then on the other side of that is the build to rent, which is becoming more prevalent in the market now. We're very behind compared to other countries in build to rent. It's far more popular in London and areas of Europe than it is here. But I am kind of wondering, if you got any comment on that? Cam, maybe we come to you because you're probably more aware, because you do work with us at Prosper, of those reports. Do you see them being significant?
The reports or the build to rent?
Well, the whole dynamics of the things that we just don't see, or we perhaps don't take into account when we just rental vacancy rate alone and saying, oh, I mean, immigration is very unpopular. It's unpopular with everybody. Nobody wants mass immigration. The vast majority of folk that are driving around and can't get where they need to get, and remember a few years ago, it was much easier to commute to work than it is now, are saying we've got too many people. I hear it here and I hear it overseas when I talk to contacts that I've got overseas. It's the general cry. But, we're analysing stuff based on, okay, we've got mass immigration, we've got record low rental rates. And if we just adjust one or the other, we build more or we lower immigration, it's going to suddenly evaporate those problems. And I guess what I'm saying is actually the problems that we're not seeing, which is a little bit of what you said in terms of, I actually don't think that we do have a supply problem. And I guess if we're talking about roof space, we absolutely don't have a supply problem.
So I'm interested in what you were saying before about these new building standards for landlords in Victoria. When did that come through? Maybe you could share some
it came through
details.
It came through, I think it was a couple of years ago that they did a rental review and they did the rental legislation, and now property managers have about 150 boxes that they have to tick now that the property is rental compliant, and it goes from having an energy efficient shower head to having a range hood that is a certain distance from the bench top to having plug points. I mean, anybody that rents, and I do rent where I live, I'm a rent vestor, so I don't own where I live. You know, you have to pay so much for electricians to come to the property to assess the plug points, and everything is compliant. And that level of compliance is now becoming so granular that people are saying, well, hang on a second, what do you mean the range? You know, I've had tenants living here for the last 4 years, and now you're suddenly saying that the plug point is too close to the sink. I mean, and I've got to move it in order to be compliant. And what's the worst that could happen? Well, you know, the tenant could get hurt and they could sue you. You know, I mean, some people are not following those compliancy things. And then I've got other people that are saying to me, well, look, if this becomes a problem, I'm just not, I'll either sell it or I'll just keep it empty. Yeah, it's a level of ridiculousness in a way, because it's not assisting the supply. There's a standard that you need to have in the legislation, and then there's a standard that goes a little bit above that. I mean, we have to have warnings on blind cords now. I'm not saying that these are bad things, but you know, they're warnings that it can strangle a child, or the switch. And
This is Victoria for you, though.
yeah, so there's all these
classic
like
Victoria
things that have to be ticked. And so even if you're buying quite a new property, it could be that you have to do work on it before you can actually rent it out. And then of course you have to pay for someone to come and check the smoke alarms and everything. And you know, like I said, there's a level that's sensible, and then there's a level where you say, well, the lady that spoke to me about her range had been too low, you know, said, well, they're saying that I've got to remodel the whole kitchen in order to get it higher. And you know, she said in the end, I think she told the property managers, just rent it anyway. I'm not gonna
just ignore it. I mean, yeah, that seems a bit extreme. I'm in two minds. That, you know, if that's with the building, if that's fine with the building code and that built it 4 years ago, it's very hard to then say, oh, it should be different for, you know, renting it out. But owners can live there and it's fine. So, you know, probably that stuff should be in the building code. But yeah, it's funny because in here people complain about some of the requirements. And I remember when I first bought an investment property, the requirements were you had to have a door on your toilet, you know, and you had to have windows that open and close in you know, every room. Like, it was pretty basic. It was none of these details. And I think, yeah, some basics are good. To get to your other point about, you know, the build to rent, and yeah, that's going to be an interesting one. And I do wonder if the effect of those properties comes through into, for example, SQM's vacancy rate metric, because they're generally self-managed and advertised. And I don't know if they're often on realestate.com and other things. So there may be more this pool of potential rental properties that isn't getting picked up. And I think that's also true with purpose-built student housing. You know, you may have one ad for your building just so people know it's there, but you might have 450 beds in the building constantly turning over with, you know, maybe half a dozen or a dozen available at any one time. So yeah, it's a bit hard to see. Build to rent, you know, I think if interest rates come down, it might make it a little bit more attractive, because, you know, you got to get a yield advantage for putting your money in build to rent over cash, right, as an investor. So I think it could surge, but my understanding currently is that the market for this is generally the high-end premium, you know, hotel-like accommodation where you can actually make a little bit of extra margin on. We have one here that's got a lot of rental, and they have a shared Tesla in the garage that renters can access through a booking system, and, you know, a library on the rooftop, and all these, you know, facilities, and it costs you, you know, $1,200 or $1,500 a week to rent there. So I don't, you know, that's fine, go and do it. but I don't think as an affordability policy, as a broadly applicable method for getting lots of housing built, it's going to be substantial in Australia.
Mm. The rooming
Yeah.
houses are also interesting because they don't get picked up. I know a lot of people that manage their own rooming houses. And of course, the advertisements that go out aren't going to be on realestate.com. You know, the advertising rates are sometimes too high for that. And you've got other platforms where people that are in looking for accommodation are checking. Yeah, I mean, it is that case that it's just not picked up on the stats, and also acknowledging that there is a lot of empty accommodation that it goes under the radar. So I don't know that the supply issue is as frantic as it is. And despite the number of investors selling in Melbourne, we don't have vacancy rates squeezing lower and lower and lower and rents rocketing upwards. It seems to have
in fact, the opposite. If you look at SQM's vacancy rate, they were 1% a year ago, and now it's 2.2%, right? So,
but investors selling shouldn't change the vacancy rate, because if an investor sells, a first home buyer buys, and they don't, and you have one less renter. So
that's right. It's a compositional shift.
Yeah,
so
it doesn't change either.
That's just overall, I think, a reflection that there's no urgency left. People aren't, rushing to outbid each other and push rents up, because, we've reached that rental equilibrium, and people are spending more time trying to shop around, and the pressure's gone a little.
There's also been a rise in group housing. So flatmates.com's recorded a massive increase in group housing. Also, unlike the mortgage market, you can't leverage rents. So, PropTrack released their quarterly rental report, and according to them, asking rents have risen by over 50% since December 2019, and they've gotten to a stage now where they've hit an affordability ceiling. So, and according to CoreLogic, the percentage of median household income spent to rent the median house is also at a record high. It's never been higher. So once it gets to those sorts of levels, there's not much upside to rents anymore, especially when you can't leverage it, because rents are linked to income.
Yeah, it's going to be interesting. Some data just popped up on my screen from the US. The BLS repeat rent index for new tenants, and it's down 2.43%. I'm just seeing if this is year over year, quarterly. So rents are really falling in nominal terms in the US after that huge surge in 2021 and 22, where they went up 12% a year for 2 years just about. They're now actually falling in nominal terms. So I do wonder, come 2026 and we have this conversation again, whether we're in a similar boat, nationwide.
Yeah. Just finally, I want to point out what's really interesting about the downturns that we've had, over recent decades, is if you look at the 1974 collapse in the property market, it was a very severe commercial collapse, as was the early 1990s collapse. It was commercial median prices, I think in real terms, dropped 50-60%. And when I go back and look in the property stats at what office buildings were selling for, I mean, their prices halved between 1989 and the mid 1990s. And actually, interestingly enough, for anyone that's wondering, that's exactly what happened to home values as well. The median data doesn't pick it up because it's only picking up the middle number, of a group of sales. But when you look at individual pricing, the collapse, when we do have the bottom fall out of the property market, can have a significant impact if you have to sell your property in those down years. You lose all buyers. What's your property worth? Your price is not worth a lot. But what's significant, I think, about this cycle is that we've had such a huge amount of building, including office building, in the 2000s, in the lead up to the COVID pandemic. And then over the pandemic, we had a lot of government spending to stimulate construction at that time, record amount of infrastructure spending. And so in Melbourne, there's office buildings that are now being completed into a market where there are soaring vacancy rates, which are still extremely high. So I would imagine that we're still in this situation where we've got a lot of underutilized stock in prime central areas, I can't see them converting it into residential rental stock, but it does signify the same as when you saw in the build up to the 1990s, where you saw a massive amount of building into that peak and then such a dramatic downturn, which in Melbourne, median prices didn't start to take off until they started to show green shoots in 1995 and then really lifted off in 1997. And then, you know, things started obviously to recover very strongly through the 2000s. But it could be that really pulls things down as well when we get to that crunch point. Any thoughts on that? Leith, do you want to throw in, and then we'll swing to Cam?
Yeah, well, I mean, firstly, one thing you said is interesting. You said you don't think that they'll convert to residential. It's very hard to actually convert office towers into residential because the aspects are wrong. So, for example, you know, I think back where I used to work at Goldman's, a big, massive, wide building had a central toilet in the centre, and then just, you know, windows all around, an open plan office. Well, you got to completely, you know, it's very hard to turn that into an apartment building. You need to totally rework the plumbing. You don't have enough windows because if you want to convert them into individual apartments, say 10 apartments to a level, you're going to have no windows for a lot of those apartments because the windows are on the outside. And so, you know, it's a very small proportion of commercial office buildings that are actually amenable to get transition into residential. Most aren't, you know, aren't appropriate. I'll just make that point. That's funny. That the rest of it is, you know, pretty typical. So often these, when you get these commercial construction booms, etc., also with high-rise residential, they take years from approval to finishing construction, and often by the time that they finish construction, it's into an economic downturn. Because they were sort of, you know, planned during a boom and then they arrived during the bust. And that's kind of similar to what you were mentioning about this world's largest, you know, high-rise tower that's planned for 2028. So that could arise by the time, you know, downturn arrives. Also, you know, the nature of the economy has changed a bit since these high-rise commercial towers were, you know, were devised. So obviously we had the pandemic, we got more people working from home now. I think that's actually a structural shift. So although a lot of workers are heading back in the office, very few of them are heading back full time. So pretty much in my area, you know, I live in a white collar area in Melbourne where all my neighbours, etc., we're all sort of, you know, white collar type workers. And most people that I know now, they don't work in the office full time anymore. So they used to before the pandemic. Now most of them work 3 days a week, maybe 2 days a week. Most of them work from home at least a couple of days a week. So that will have reduced demand for office space, and most of the places that these people work at now have got sort of hot desks, so they don't have their own desk anymore. They go in there and they just set up a desk for the day, and companies have done that to reduce the amount of office space they need. So yeah, I think we're, you know, especially in Melbourne where the economy sucks, we're going to be we're probably sitting at, you know, likely to have a situation where we're going to have an absolute glut of commercial office buildings, and you know, probably for rent and vacancy signs everywhere, and not just in the commercial space, but also retailers, etc. Another thing that pandemic saw obviously was huge lift in online sales platforms. So Amazon obviously took off, eBay was already there. We got Shein and Temu and etc. And that's likely to, you know, lead to the closure of more retailers and, you know, more empty shop fronts on that front as well. So it's not really a space I'd be looking at investing in personally, but then again, I'm not an expert.
Yeah, absolutely. Yeah, I mean, I live in St Kilda, and COVID absolutely decimated. It just, the shops were already under pressure along Ackland Street and Fitzroy Street, and now those streets which were once thriving, brilliant little shopping strips are really struggling.
Same in Chapel Street in Prahran, same deal. I walked past there a couple of weeks ago and I couldn't believe every second, third shop front seemed to be empty.
Yeah. Noticing exactly the same. It's really sad to see it. It's like, you know, I look at Melbourne's economy and just think, gosh, it's such a mess. You know, there's a lot of mess to clear up in Melbourne. But as we're sort of getting tight on time, Cam, do you have any comments on the office sector, the commercial sector?
No, I think Leith is spot on. Yields tightened a lot in commercial in the 2010s, and I think it's going to take a while for things to recover and yields to rise, prices to fall, etc. So, yeah, I don't see a big appetite for a wave of conversions. Maybe in some areas. I mean, the Gold Coast is surely going to have plenty of office, just simply because of the huge migration surge there and the general boom in economic activity. But yeah, Melbourne, surely not. So yeah, agree with Leith on that one.
Yeah. Okay. Well, thank you, both of you, for joining me. Brilliant and very, very interesting discussion. And yeah, we'll do it again.
Thanks for having me.
Thanks, Catherine.